All right, everyone. Well, welcome in. We're here in late fall in 2025 with another markets and economy update. So, welcome in. Thanks for joining us and giving us some of your time. Want to make sure that if this is your first time joining us, we introduce ourselves. And if this is not your first time, you're going to hear it again. So give us about 30 seconds. I'm Jarrod Musick. I'm the CEO here at Destiny Capital. So my job is really twofold. I work a lot with our client service teams and our clients, and I also sit on the investment committee along with Tim Doyle, really in the role of being his thought partner. Tim?
Yep. Yeah. Thanks, Jarrod. My name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital. As Jarrod mentioned, I manage our investment committee. And on that committee, we really do a number of things. We conduct capital market research, fund due diligence, investment manager selection. We execute portfolio construction, what we own and why. We execute trading, rebalancing, and much more. And and conduct webinars like we're conducting here today. We've got a lot of interesting stuff to talk about, so I'm excited to get to it.
Awesome. And before we dive into all of the goodies, we always have to do our disclosures. So Tim and I both work for Destiny Capital, and we are officers of said firm. We're a registered investment advisor, which is in the business of providing financial guidance and advice along with investment management. We do that as registered through the SEC. We are not CPAs or tax attorneys today or any of these. So please consult those people. And if you don't work with us, consult with your own wealth advisor before you make any irrevocable decisions. This is an educational talk today. So we've tried to make sure that all the facts and figures are accurate and timely and up to date. There's the potential we made errors. So if you already work with us, please reach out to your client team here if you have any questions as a follow-on. So with that being said, the topic du jour, government shutdown. As we record this, we're a little bit more than 3 weeks into the non-critical function areas of our federal government not being funded and working. So since it's on everybody's mind, we wanted to take some time and talk about it from an investor perspective. Tim, can you kind of walk us through what we're seeing and where our position is today?
Yeah. This is obviously, like you said, Jarrod, an important question, one that's coming up in almost every client meeting, according to our strategists and coordinators. So we thought we'd give you an overall, perspective from our view as to where we are, what the impact is, and what it means for investors, and how markets have really reacted since the shutdown began. So, as we all know, the shutdown began on October 1st. And this now being the 23rd day of October, that's roughly 23 days that the government's been shut down. So that marks the second longest government shutdown in modern history, with the longest being 35 days back in 2018. So when we talk about the impact, really, right now, federal workers are kind of taking the brunt of this as far as the government shutdown is concerned. We've got 750,000 federal employees that have been furloughed. We've got paychecks that have been delayed for millions more. We've seen the closures of federal agencies, museums, parks, and so forth across the country. And then we've got the economic impacts that we have. We've got some estimates from sources like the Congressional Budget Office that believe that every week that the government is shut down could reduce annualized GDP by 0.1 to 0.2%. Those numbers sound pretty small when you're thinking about a week-over-week basis, but if this shutdown continues, those numbers do add up quickly and can potentially have a material impact on growth, on GDP growth on an annualized basis. So something to be mindful of. The effects, the impacts are somewhat minimal as it relates to the economic growth right now, but that could definitely add up. And then you think about consumer confidence. Consumer confidence could be negatively impacted. Consumers were already worried about inflation, the labor market. Then you add a government shutdown on top of that, and they could say, well, is now the time to spend? Should I tighten up my wallet? Is that going to slow down the economy as consumers and consumer spending slows down? That's not something that's necessarily guaranteed, but that's something that could happen. That could be a behavioral element when we talk about inflation, the labor market, and then a shutdown on top of that, we could see some changes in consumer behavior. And then we think about global confidence in the fiscal stability of the United States. So we already have global concerns about the debt and spending in the United States, and the need for a shutdown on top of that. Then global investors could be looking at U.S. debt, so U.S. Treasuries, with a little bit more skepticism, saying, hey, maybe we need a little bit more of a risk premium if we're going to be purchasing your debt, your short and long-term debt. So a couple things to think about there. And to me, in my role, one of the most important elements that I'm concerned about is the fact that economists and investors are virtually flying blind right now. As I spoke to earlier, we've seen in recent months, we've seen inflation ticking higher. We've seen cracks develop in the labor market. And when the government is shut down, we do not have access to crucial data. We don't have CPI, for example. We don't get inflation data. We don't get labor market data from the BLS. We don't get GDP numbers. We don't get housing data from a variety of government resources that we count on for this reliable data. And this comes at a time, a very unfortunate time, namely for the Federal Reserve, because the Fed is at a point, because of inflation and because of cracks in the labor market, where they are set to make crucial decisions around monetary policy, namely around raising or lowering interest rates. And investors are expecting the Fed to lower interest rates by another 50 basis points between now and year end. But does this lack of access to data change that? I know the Fed does have their own internal sources for data, but they do rely on CPI, on PCE, on the BLS jobs reports and things like that for the large crux of the data that they're reviewing. So that's something that concerns me, because we don't know where inflation is right now. I think we all believe it's higher because it was set to move higher. We all thought that the labor market cracks were appearing in the labor market that was expected to continue. We don't know because we don't have those numbers. So that's a frustrating thing as an investor, and something we hope gets resolved very quickly so we can start seeing those numbers, digesting them, and then thinking, hey, what does this mean for investors moving forward? Now, finally, when we talk about the market reaction, thus far, markets, the U.S. stock market, bond markets have largely shrugged off the shutdown. I think this over the past decade or so, we've seen a relative desensitization to politics when we're thinking about investor behavior and investor mindset. We've seen a lot of shutdowns. We've seen a lot of 11th hour deals around debt ceilings, and markets, maybe 10 years ago had been reactive to that, with maybe a sell-off if the government had shut down. We're just not seeing that right now. Markets are focused on earnings. They're focused on what we're seeing in the economy as we view it, and so far, we haven't seen a sharp reaction or a negative reaction in the stock market, and that's been a good thing for investors overall. Will that continue? Obviously, that's something that remains to be seen, and the length of this shutdown may have something to do with that. So we'll see if we get a resolution here. But Jarrod, you made some interesting points when we were offline. I don't know if you want to chat about that or anything else related to the shutdown, and when we might see an end in sight, or what it might mean for investors. I'll have your perspective on that as well.
Yeah, I think that's a great overview, Tim. I mean, unless you're an economist or somebody in an investment management seat, you kind of don't care as much that, oh, my premium data sources for, core information aren't there. But we do have clients who have gone to, federal, museums and national parks and been met with a closed sign at the door. That's not fun if you take a trip somewhere. But those seem like small things overall to this point, right? The military is still funded and getting paid. Social Security checks are still going out. Medicare benefits are being paid, right? So the day-to-day pain really isn't being felt unless you're a federal employee, in which case this is very, very disruptive for you and your family. So when we think about an area that could cause pain, because when we're trying to assess, how long is this likely to continue, how much pain is being experienced by voters, is certainly a part of the equation. And read something interesting that EBT and SNAP benefits, so essentially food stamps, that come out on debit cards and allow people on the program to go to grocery stores and get food. Those were funded in advance through October, but that funding is expected to run out within the first week to 10 days of November. So past that point, people who depend on that program, and there are 41 million beneficiaries currently of that program, so a little bit more than 10% of the US population receives food stamps, they will no longer be able to purchase food. And that could certainly be a moment of pain that compels a political process to arrive at some type of negotiated solution. So certainly hope that we don't get there. That would be very destabilizing for those families, and would likely lead to some additional social unrest to some degree. So as we record this here, as Tim said, on the 23rd of October, we're getting close to that timeline. So we may be at a resolution here in the next couple of weeks. We may not be. They may find money to plug that hole. They may decide that, well, we're going to let the pain be there for those people as a forcing mechanism until one side or the other wins in their argument. We truly don't know, but that's something that we'll be watching closely, because as you said, Tim, as investors, ultimately, it really does impact our decision making. Stability of the U.S. federal government is a factor here. So going back to what's happened so far this year, and where are we at, and how did we get here?
Yeah, I thought amazingly, we're closing in on year end. I still can't believe we're at the end of October here, but I thought it would be a good time to provide a general update on the stock market, where we are, where the major indices have moved on a year-to-date basis, and some of the why behind that. Because it has, all things being equal, been a very, very good year. It's been a volatile year, but where we stand now, it's clearly been a good year. We've reached all-time highs throughout 2024. It was interesting to note that throughout last year, throughout 2024, excuse me, the S&P 500 hit 55 new all-time highs. 2024 was a great year. That was a banner year. That was an enjoyable year for investors. I don't know that many investors were expecting to see something similar in 2025. It quite hasn't risen to that level, but it's been a very, very good year thus far as well, with the S&P 500 hitting roughly 34 new all-time highs on a year-to-date basis. And like I said, we're not at the end of the year yet. And some of this performance you can see on the chart to the top right, where we've got performance of the S&P 500, the Dow Jones Industrial Average, the NASDAQ, and the Russell 2000. And when we talk about the Russell 2000, we're kind of referring to smaller companies, small caps. And we've seen a really resilient rebound. That's some alliteration right there. We had a 19% drawdown in the S&P 500 between March highs and the April lows. That's a considerable move, a move lower. And what's very, very concerning at the time, I think if you all recall what happened then, we saw a variety of changes to global trade policy with the implementation of steep tariffs. That created a steep market sell-off due to uncertainty. And then since then, we've seen some of those tariffs walk back a little bit. Markets have stabilized and then moved higher, and quite higher at that. So as of yesterday, these numbers are as of October 22nd, we see the S&P 500 up almost 15%. We have the Dow Jones Industrial Average up about 11%. The NASDAQ up nearly 17%, and the NASDAQ is a little bit tech heavy and growth heavy, so that's a little bit higher than the S&P 500, up about 17.7%. And then the Russell 2000, small caps have been concerning for quite a while. They have struggled for the past 2 years, while most other indices have moved higher. But finally, the small caps are getting into the game and moving higher. They've rebounded quite nicely and are up almost 13%. On a year-to-date basis. So, what has spurred this move in 2025? Why are markets moving higher? Well, it's largely due to strong corporate earnings. Earnings growth are what investors primarily pay attention to. It's what we're talking about when we're talking about earnings season. So we get quarterly earnings season every quarter, and we're looking at earnings growth at either in companies, individual companies, or as an index as a whole, for example, the S&P 500. So when we're talking about the S&P 500, Q2 earnings growth was 11.7%. That's very, very strong. And then moving over to Q3 estimates and Q4 and then Q1 of 2026 estimates are to see earnings growth of 7.5%, 11.9%, and 12.8%. So no end in sight for really strong earnings moving forward. And that's something that investors can really cheer. That's something that's very positive on a forward-looking basis. And as we all know, investors are forward-looking. Then we think about profit margins, and I have a chart to the bottom right to show illustrate this. Q2 profit margins were very strong, up at 13.6%. And Jarrod, maybe you could take a moment to talk a little bit about profit margin from the perspective of business owners, entrepreneurs, what that might mean, and what strong earnings, what strong profit margins and expanding profit margins mean for business owners and investors.
Yeah, absolutely. I think it's interesting. If you look at that chart to the bottom right, we can see that from 2002 forward, we've come up in terms of profit margins for the 500 largest publicly traded U.S. companies from about 8% to where we're at today, which is hovering right around 14%. So that actually means that companies are getting more effective at generating profits per dollar of revenue. So you can look at that as adoption of technology, adoption of automation, potentially AI starting to help a little bit here. I think that's a very mixed bag as we're looking at how productive AI allows companies to be. And then some of the less positive ones, offshoring, outsourcing, things like that. So generally, companies are better at being profitable than they were previously. And so when we look at performance of U.S. equity markets over the last couple of decades, you can look at, we're a little bit more expensive now. Markets have continued to move up and up and up, and there's a lot of factors there. But one of the key ones really is that we're generating more profit per dollar of revenue, which is a great thing as an investor. So I think that's a trend that we've seen for a long time that we expect to be persistent.
Yeah. Yeah, excellent. Great points, Jarrod. Yeah, thank you for that summary. And when we talk about some other areas that have spurred this move in the financial markets in 2025, we'd be remiss if we didn't talk about fiscal and monetary stimulus. As we all know, earlier this year, we had the One Big Beautiful Bill passed. So that's a form of fiscal stimulus. Those are tax cuts. Markets like tax cuts that tends to, on average, spur growth. So those are pro-growth policies that can move markets higher. And then we also had the Fed cut interest rates 25 basis points at their last meeting. And then investors are expecting that the Fed will cut interest rates by another 50 basis points between now and year end. And that's, again, intended to stimulate the economy, spur growth, improve the labor market, and so forth. That could be inflationary. That remains to be seen. That's something that we're keeping an eye on as a potential negative impact of that monetary stimulus. But nonetheless, markets have reacted positively to that. And what has that really led to? And Jarrod, you kind of touched on this a little bit. It touched on higher valuations in a top-heavy S&P 500. So when we talk about a top-heavy S&P 500, we're showing that the top 10 companies of the S&P 500 make up 40.2% of the overall index. That's a record high number, and that's a staggering number. And then we're talking about higher valuations. So valuations of the index as a whole have moved much higher with a forward PE ratio of 22.7. That's definitely on the high end relative to a historical average closer to 17.5. So we're seeing higher valuations, and that's something that investors need to keep an eye on as well. And that's something we've talked about quite a bit in previous webinars and markets and economy blogs and so forth. And because of these higher valuations and because of this top-heavy S&P 500, we've seen a little bit of an asset class rotation throughout 2025, where some investors have rotated out of U.S. equities and into other asset classes, namely global stocks. And that's been an interesting area of the economy of financial markets to track. And we'll touch on that next because I do think that's important to focus on to close out the webinar today.
Yeah, I think that's a great segue into our last slide here today. I know we're not drowning you in slides. We're spending more time per slide, which is great. When we think about investing for clients and how we build model portfolios and how we do asset allocation and why we choose to prioritize certain asset classes at certain times, I think this is a great year to look at, when we can see some of those shifts. So, well, what's happened with a little bit of the rotation between U.S. equities and foreign equities, and then what role has, the value of currencies played in that, Tim? Because I think that's fascinating.
Yeah, I think that's one of the most interesting aspects of this entire situation we're seeing. When we're coming into 2025, I don't think most investors were anticipating an S&P 500 up, let's call it 15%, as we head into the end of October. I think that most investors were expecting a little bit more reasonable returns, maybe 5, 7, 10% on the high end. So 15% is certainly an excellent number. And one other item I don't think most investors had on their, as we say, on their bingo card, was a 27% return for global equities. And you could see this on the chart to the top right. The blue line represents the S&P 500 on a year-to-date basis, and then the orange line represents the MSCI ex-US World Index. So basically, every other stock except for US stocks are represented in that orange line, and they are up over 27%. That's a staggeringly good number, a very strong number, and we'll touch on this later, as international stocks have historically struggled. So I don't think many investors were expecting that type of rebound going into this year. So we thought we'd touch on the why behind that move. What has led to that move in international stocks, and why are international stocks, at least on a year-to-date basis, outperforming US stocks? And a lot of it has to do with the falling dollar. So international stocks get a currency boost when the dollar declines. So we've seen thus far in 2025, the US dollar has fallen roughly 10% relative to foreign currencies like the euro, the yen, you name it. And this has provided a significant boost to returns in international equities. When we think about valuations, we were just talking about US stocks, the S&P 500 being quite expensive at a 22.7 forward-looking price to earnings ratio. Well, international stocks have much lower relative valuations. They look a little bit cheaper. When we talk about valuations and we're talking about international stocks tend to look quite a bit cheaper than US stocks, whereas US stocks look quite a bit expensive. So we're seeing a little bit of a rotation for investors to chase what they deem to be better deals, potentially internationally, stocks that might be fundamentally undervalued, and hoping that they see a boost from buying lower and potentially moving higher from there. Then we think about global interest rates. We're seeing lower local interest rates in regions and countries across the globe, as central banks across the globe lower interest rates, thus boosting economic activity, kind of like we're seeing here in the United States with the Fed reducing the Fed funds rate 25 basis points in the last meeting, and expected to move interest rates a little bit lower on a forward-looking basis as well. Then we have fiscal stimulus as well. Internationally, we've seen pro-growth policies where governments have adopted stimulative pro-growth policies that have boosted infrastructure, defense spending, and that's provided a boost, particularly to infrastructure and defense stocks, particularly in the Eurozone. We've seen that happen thus far in 2025. We've seen improved corporate earnings internationally and improved economic data. So earnings growth has rebounded in international stocks, and economic data looks a little bit stronger around inflation, jobs, growth, all of the things that we look at when we're thinking about the US economy and US financial markets. And then again, we touched on this a little bit earlier on the first slide, I believe. There's a little bit of uncertainty around the US. So earlier in this year, we had wholesale changes to trade policy with the implementation of steep tariffs. That created a lot of uncertainty about the US markets as a whole, because we also have the ballooning public debt. We've got constant deficits, political gridlock, which ties into the shutdown that we talked about earlier. So all of those things have kind of created a little bit of a perfect storm to boost international equities, at least on a year-to-date basis relative to U.S. stocks. But I think, as we always do as investors, we have to look through a longer-term lens. And I thought this final chart was a bit of a good summary to touch on as it relates to the subject of international versus domestic stocks. And this chart to the bottom right essentially shows relative outperformance of U.S. stocks relative to international stocks over time. So as long as this blue line is moving to the top and to the right, that means that U.S. stocks are outperforming international stocks. And as you can see, I've drawn that red line there. We've had 16 years of U.S. stock outperformance relative to international stock. That's, you know, almost 2 decades of outperformance. You can see right at the start of 2025 that reversed sharply, and we all know that, and we could see that in the performance differentials we're seeing in the chart to the top right. But we've also seen that slow down and even rebound where U.S. stocks are starting to outperform international stocks, at least over the past few weeks and months. That shifted again. So, you know, is this international outperformance the beginning of a longer-term trend? I really think that remains to be seen. I think the U.S. economy is, you know, I would call it the place to be for investors. You know, do you want to own an allocation to international? You know, we believe in diversification. Absolutely. So diversifying regionally, geographically, absolutely makes sense in certain situations. But now is not necessarily the time to pull all your chips out of the U.S. stock market and shove them into international stock markets. So I thought, you know, closing with a little bit of a longer-term perspective, a longer-term lens, which is how we view financial markets at Destiny Capital, was important. So we don't get so caught up in the short-term trends, the short-term outperformance of international versus U.S. Like we've seen over the last, you know, call it, you know, 8 to 9 months. So. Jarrod, anything else you wanted to add on that slide, or anything else that we touched on today?
No, I think that's probably a good place for us to wrap up our conversation for the day. You know, I feel like the content of these, when we do them every month, is there's some new big thing that is really important for us to all pay attention to and understand, and then they tend to pass, right? Unless it's inflation, and then we talk about inflation every single month until we die. But other than that, you know, the government shutdown is certainly top of mind. So I'm glad we went through that. I'm fairly confident that we'll have a conversation in November, and we'll be talking about what triggered the end of the government shutdown and where we go from here. We might not, but that would be my best guess. And then, you know, as we look at currency issues, cost of capital, dependability of federal governments, all of those things, those really are key long-term influencers for us when we do asset selection. So this is actually great timing. Tim leads our capital market assumption review here in the fourth quarter of every single year. And that's a very, very involved process. And we'll be weighing those things together and saying, which asset classes do we need to allocate to for which clients? So really fascinating from our end. Hopefully this was helpful for a little bit of context about what's happened so far in the year and what's happening right now. Tim, anything to close us out from your perspective?
No, I think that's a great summary. I just, as always, appreciate everybody's time hopping on these webinars, and we look forward to doing the next one soon.
Yeah, and please head to destinycapital.com, throw questions in the CIO mailbag, reach out to your client service team. If you have stuff that you want us to do a deep dive on, please let us know. Honestly, client questions are one of the reasons we spent so much time on the government shutdown today. So we're here to give you guys the information that you would like to hear. So please let us know what you'd like. Thanks so much for joining us, and we'll be available and back in front of you again soon. Thanks everybody.